Thank you for joining us today. This is the past conference workshop after last week's WBS Spring Conference. And it's on practical machine learning for quantitative finance. This is the first workshop in the series. So there will be, it's a 2-day workshop after the conference, which will be specific to, we need something to work on. So this will be on interest rates. But we're planning to continue this workshop series after the conference, both as post-conference workshops at future conferences, as well as some webinars that are being planned for later in the year. So please stay tuned to WBS mailings. So the workshop today is practical machine learning for quantitative finance. And first day, it's a 2-hour each day, so tomorrow and today and tomorrow. Each day, the first hour will be on theory. In the second hour will be on practical hands-on session. We'll actually run some models in Python. So before I start, I would like, first of all, to ask a few questions from the audience, because I will run it a little bit differently depending on how many people would like to participate. So the plan is, first of all, participation is strictly optional. If you'd like to just listen in, if you'd like to just observe what we're doing with the code, that's perfectly fine. And in fact, I've done many workshops in which I was basically working with the code and everybody was, looking at the screen. However, if you're a quant, if you're a coder, if you know Python, and if you'd like to use this opportunity to actually try to run these models, perhaps change some settings, see what the models do, it's certainly possible. And the repository is available on GitHub, so you'll be able to clone it. And install basically the prerequisites and follow along. And we have a breakout room where my colleagues will be able to help you if you'd like to do that. So I'd like to see a show of hands. I don't know if Zoom has actually some voting function there, but can just someone tell me? Let me just see if they. If there is
hands up in the
hands up,
thing.
raise your hands, that's right, so or I guess raise hand, there's an option, right? So do we have raise hand here? I don't see the button.
If you click on reactions, I believe, then you can raise hand there, and then if you look at the participant list, you'll be able to see who has a hand raised.
Okay, 1 second. Right, okay, so I see it, yeah, okay. Right, so please raise your hand or type in the chat if you'd like to actually clone the repository and work with us live during the second hour. So anyway, we need to go through some slides, but I'd like to see how many people. Okay, so I say 2 so far. You see, maybe there's a grid that will be a little more clear. I apologize if I'm looking to the side because I need to, I'm on full screen mode, so I'm using another screen to see what's going on. All right, so I see 2 people so far. Anyone else? Okay, great, right. So so in this case, what we'll do is please follow what I'm doing. And if you have any questions, please write a direct message to my colleagues. So there's Anastasia Chumak and Andrew Samadorov. And Andrew is the one who worked very closely with me on this code just in the days leading to the workshop. So please write to Andrew direct message, and he'll either help you or he'll alert me if if he would like me to clarify something. And hopefully you'll be able to run the models. Also, after the workshop, you will get a copy of the slides. Every participant will get a copy of the slides. And also, as I mentioned, the repository is on GitHub. It's an open public repository. You'll be able to clone it, fork it, basically, take it forward. And hopefully, you'll be able to get some good hands-on kind of feel for the models. All right, so now with that, let me get to the workshop. So before I start, I wanted to talk a few minutes about what the workshop is like and why this workshop is perhaps a little bit different from some of the machine learning workshops you've attended before. Most machine learning workshops focus on the machine learning software, right? On algorithms for machine learning, on the implementation of these algorithms in popular libraries. So, this is something that's not specific to finance or mathematical finance, right? So in other words, it's something about, well, how does the optimizer work? How does a neural network work? What's Markov chain Monte Carlo? So, all of these are very worthy questions. And I think there is no shortage of materials to answer these questions. There are excellent courses from some brilliant people who have invented this technology. There are a lot of webinars, a lot of workshops. You can also Google a lot of stuff, and there are a lot of books. So I felt that I cannot really contribute to any basically any explanations that I will provide in that direction, namely how does machine learning, how these algorithms work, will be just a drop in the bucket, because there are so many brilliant sources of that information. But what I thought was lacking is information on how to apply these models specifically to mathematical finance, because mathematical finance is different from where these models are normally applied. And the main difference is that scarce data, right? So in finance, yes, there are some areas in which there is plenty of data. There is tick data. There is, even if you look at things like equities and so forth, even if it's not tick data, it's still plenty. There are large universes of names, still probably not as much as some of the terabytes or petabytes of data and things like images, but a lot. Right, so there are some areas in finance where there is very little data. For example, interest rates. Right, there are not a lot of currencies in the world, especially currencies with liquid financial instruments. And some of these horizons you want to look at, they're long horizons, so you have fewer data points. So I will focus on specifically how to use machine learning when you have not big data but little data, small data. Right, when you don't have enough time series. And in order to prove that these methods work, I will use publicly available historical data, but also I will generate some data using traditional quant models, Hollow White model, and I built a few models that are a little bit more realistic in real world measure. And then we'll use these models to generate the data, and then we'll try to use machine learning to learn from this data and see if the predictions of machine learning correspond to what we know we generated. So this way, we'll be able to convince ourselves that the algorithms work, and then we'll be able to apply them to real data. And the focus of this workshop, as far as the selection of the algorithms that we will be covering, is specifically on those algorithms that work with small data, right? Not big data, but small data. Namely, those that are robust when you don't have enough data to train on. So you will see that some of the things I'm doing are not perhaps as cutting edge as we all would like to be. Of course, it's very interesting to work with the most advanced algorithms. Sometimes these algorithms are also those that require more data to train. So I will use today a very simple feedforward neural network. Nothing very advanced. And tomorrow I will use also a very simple algorithm, which is called restricted Boltzmann machine, RBM, which is practically the simplest and the oldest generative model. So both of these algorithms are essentially, they're older, perhaps, algorithms. They're very well understood. And the advantage of these algorithms, as opposed to some of the very deep networks that people are looking at in things like image recognition or speech recognition or semantic analysis, is that you can train them on small amounts of data that we have in finance, especially for those instruments, for these asset classes where you don't have a lot of names, right? So because there are two challenges here. So one is, even if you're talking about equities, credit, commodity, commodities is actually not a category. So if you have equities and credit, you have hundreds and thousands of names. When you're talking about commodities, currencies, you have only tens of names. So that's the challenge, and I will specifically talk today about how to use this technology for small data, and it turns out that you can use it with success. All right, so let me get started. First of all, introduction, right? So we will build today. We'll build machine learning model for interest rate and real world measure calibrated to historical data. So I will focus on interest rates. The same approach can be used to model any curves, right? So credit, inflation, commodities, and so forth. So any curve-like asset class, you can use a very similar model. But we only have 2 hours, so I'm just going to do interest rates. Okay, and the problem that we will try to solve with machine learning is specifically calibrating interest rate drift and real-world measure. And that actually happens to be not a toy problem, but a very long-standing problem in quant finance, which actually goes back to the 1990s. I remember when I was starting as a quant in 1996, that problem was already pretty well known, and people were actually writing about it at the time, right? So is that all? Right, and it still lacks a definitive solution because it's really very difficult to attack this problem with conventional quant research tools. And it turns out with machine learning, you can actually do something. that help to solve it. Namely, we will be able to use to calibrate to cross-sectional data from multiple currencies, but not creating a model for one average currency, but actually helping, essentially using one currency to enhance our precision for other currencies, but still building a model that's different for each currency. And it turns out that the type of analysis that this requires is actually machine learning is able to do, but conventional statistical techniques cannot. So we will solve a real problem that actually confounds risk managers everywhere, because you need to build these models, for things like limits and so forth, or for macro investing, and it's difficult to do that. So we'll solve a real problem, not a toy problem. All right, so now we will use only public data here. The reason we're using public data is because everybody needs to be able to reproduce this. I wanted to include the data in the GitHub repository, and I did. So the source code actually is packaged together with the data, and I would not be able to do it if this data came from a commercial data vendor. So we will be using not swap data, we will be using government bond data. The model actually works better for swaps because there is more data, there's data for longer, there's also volatility data. So so this model works better for swaps, but in a workshop format, I would have all kinds of restrictions on data redistribution, and I would really not be able to share these calculations or make them freely available. So we're going to use a data set that's not as good. It's still, government bonds is something important. Obviously, there are a lot more derivatives on swaps, and there's a lot more trading on swaps than on bonds, but still, it's something very important. And this data set is free, publicly available from data.oecd.org. Includes 48 currencies, of which 16 have sufficient time series length for the machine learning model. And of course, many of these currencies or the countries, so it's indexed by country because government. Two countries that have the same currency, like for example, well, the obvious example is the euro area. They have short interest rates which are very similar. In fact, outside of a credit crisis, they're nearly identical. However, longer yields are very different because German bonds are different from bonds in some of the other euro area countries. So strictly speaking, it would be, if this was used in production, we would have to take this data set and clean it and perhaps transform it, because we essentially have multiple currencies before January 1st, 1999, when the euro was introduced, and then they all become one currency. So for all of these countries, the short rate is the same, but the long rate, the 10-year bond is different, right? So this data set includes 3 months government paper and 10-year bonds. So this creates a bit of a conundrum, because the question is, how do you count this, right? Do you count them as one currency or country, or do you count them as multiple? Because there are two risk factors. One of them is common to all of these countries, and the other one is different. Well, the good thing is that I'm not building a production model. I am conducting a workshop on how to build the machine learning software. So in order to make sure that the results are reproducible, that any quant who would like to try a different model can compare the results, I'm just not going to transform this data. So I'm well aware that there is this issue with the euro. I'm just not going to transform it. I'm taking the data set exactly as it is, and that's exactly that's why. All right, so now this is the time series, and the time series, so this is a 3-month note, this is a 10-year bond. So as you can see here, there is a very wide variability of rates. There's one crazy currency here, I forgot what it is, but it's one of the currencies that had inflation crisis, or basically runaway inflation. Most of the currencies have reasonable interest rates, but there are some low rates, especially recently, as you can see. There are some rates also of 20 to 30%. So this is a good data set that presents a range of interest rates from low to high. All right, now I'll maybe spend a few minutes on the historical context for this for this model, or for this problem that we're trying to solve. Okay, so we all know what historical simulation is. So historical simulation is something that works very well for short time horizons. We used to compute value at risk with historical simulation. Now we use it to compute expected shortfall, which is what regulators now like better. But essentially, the idea is the same, that we generate risk factor samples by adding the historical changes to today's risk factor values. And the historical changes take place over separate historical time periods. Let me turn the camera a little bit. Second. Each of these historical changes takes place over separate historical time period, whose length is equal to the model horizon, right? And the same periods should be non-overlapping to ensure that the resulting samples accurately represent the historical probability distribution. So here's what it means. Suppose that you're interested in, let's say, 1 day, you're interested in 1 or 10-day horizon required on market risk calculation. In this case, let's say you're looking for 500 samples. You go back about 2 years, and this already gives you pretty reasonable, decent, I would say, statistics. And what you do is that you take the change in risk factors over 1 day period in the past, add it to today's risk factors, and that gives you an empirical distribution from which you can calculate your quantiles. Okay, so that works well for a daily horizon. However, in market risk, sometimes you also need a 10-day horizon, which is basically considered to be the liquidity holding period until you can unload the transaction. So that's why there is a 10-day in a lot of regulations. Well, it's also not too bad. I mean, 10 days is not as good as 1 day, but still you can get tens or hundreds of data points without going back to the antiquity, Bretton Woods and so forth in the 70s. Right. Nevertheless, the calculations, regulatory calculations also sometimes require 1 year horizon. Okay, so that's a bit of a problem because if you're interested in a 95% quantile, if you're interested, in fact, sometimes in 99% quantile, right? With a 99% quantile, you need to have 100 points before you even have a point that's going to be at that quantile, right? And obviously, you don't just want to have a 1 point at that quantile because that gives you no precision, right? You need to have tens of these points such that your quantile accuracy is decent. So, well, 1 year is, of course, you're going to go back to the medieval times, and even though they did have borrowing, but interest rate markets were a little bit different then, and their dynamics will not have any bearing on what's happening today. So what do you do? Okay, so well, there are techniques which are rooted in statistics, not in models, that are used to correct for the overlapping time periods. So the idea is that you no longer can take non-overlapping time periods and get enough data points, but you can take overlapping time periods. And then when you do that, you get basically a bias distribution. And there are some techniques for correcting for this bias. I will not dwell on these techniques. That's not what we're going to use. And the reason is that, they work when it's 1 year, but when it's like 5 years, a little bit further, and the horizon that we'll use for the workshop is 5 years, they simply don't work. And the reason is very simple. You have, let me just interrupt for 1 second, ask a question. So do you see my screen, 9 slide right now, right?
Yes.
It's not frozen or anything, right? Okay, that's good, right? Okay, right. So if there is any problem with slide moving, please let me know, because sometimes happens when I'm sharing the window and not the entire screen. All right, so now, why you cannot just correct for the non-overlapping, for the overlapping time periods, for long horizons? Okay, so consider currency, such as the US dollar, that has an extended historical periods of high rates followed by an extended period of lower rates. If standard historical simulation methodology is applied naively, right, it will quote unquote predict that the interest rates have a persistent negative drift. Okay, well, it's an absurd conclusion, or rather an absurd way to build a model if today's interest rate are near zero. Because as you can see here, the rates have been going consistently down in the US and also a lot of other currencies. So essentially they dropped, about 10% during this time period. So now imagine that you take this time period and say, I'm going to take my today's zero rate or near zero rate and apply this change, right? Well, over this horizon, the change will be, will get the rate to minus 10%. And the rate cannot become, minus 10% unless a lot of things happen, like prohibit foreign exchange, prohibit Bitcoin, prohibit cash. You have to basically force people to put the money in the bank, and then they can take away 10% of that money from them in a year. And that's, essentially, not going to be a very popular move. So that model is absurd, right? You cannot say, oh, over this time period, interest rates have dropped 10%. Today, the interest rates are near zero. They're going to drop another 10%. So what it means is that starting point is important, right? You cannot just say, I'm looking at the frequency of various moves occurring. in market risk, you can get away over 1 day horizon. You can get away with that because you essentially have a starting point, especially market risk. When you think of equity, right, there is no really natural level for the stock. You really one split away from being very different from where you started. Market risk, of course, is also used for risk factors which have a natural band in which they move, like commodity prices, interest rates, credit spreads. Nevertheless, when you're talking about 1 day moves, it's unlikely that there is such a giant 1 day move that it will basically put you in the negative territory. So it's a small correction that you apply, at the edges of your distribution. It doesn't matter. But when you're talking about longer time horizons, it's a huge problem because basically it's just the distribution, a risk factor move over several years that originated when the interest rate was 10 or 15%. Is not going to be the same move when the interest rate is 0, because that would put it in a heavily negative territory. So that's an absurd conclusion. All right, so we need to do something else, right? And we need to, do a different, we need to use a different approach from the historical approach. Okay, so now how can we think about it, right? So one way to think about it, which I think is very illuminating, even though I haven't seen it, in a lot of quant literature, but I'd like to invite you to kind of follow this line of thought, because I found it extremely illuminating in understanding what the problem is and how to solve it. Right. So you may have heard that in statistics there are two schools of thinking about probability. One is called frequentist, and the other is called Bayesian. Right. So frequentist school says that in order to know probability, events have to happen, and then you look at the frequency of these events occurring. For example, you throw a dice. And you have exactly 1/6 probability of each number coming up, or you throw a coin and you have equal probability of heads and tails, right? So now frequentist, right, is basically just counting events. So this is like historical simulation, right? So in other words, you have historical period, you have market risk, you have risk factor shifts or shocks over the observation period, for example, 1 day or 10 days, or if you try to use longer, it's longer period. So you're just going to say my observation period has 200 observations or 500 observations, and I'm just going to count how many times events occur, and I'm going to say, well, the worst, let's say 5% of losses is what my risk is, right? So that's a pure frequentist thinking, right? And the problem with this thinking is that you're not considering your initial state, right? You're not considering your initial state. So some of these events that you're observing, they happen in a different initial state from today's initial state. And today's initial state has different probability. And again, coming back to the preceding example, if your initial state is 15%, downward interest rate move of 10% is completely realistic. The central bank is fighting the inflation. In fact, that's exactly what happened here in the 80s, where there was very heavy inflation, during Carter and early Reagan years, and then eventually the interest rates have come down. And this inflation was triggered by Bretton Woods, and eventually was suppressed, right? And dollar became a fiat currency. So now today, of course, minus 10% is unthinkable, right? And that's why frequentist way of thinking about models fails. So machine learning model is Bayesian. Right, and that's a very interesting thing to say, because the models we're talking about today actually are not generative model, right? So in other words, they don't generate samples. However, they analyze the probability distribution, right? And the way they analyze it is Bayesian, right? Maybe we don't even use, explicitly, at least in somewhere, deep in the machine learning algorithm, it is actually used, right? But explicitly, we don't write down the Bayes formula. But it's Bayesian in the sense that it uses evidence to work with incomplete data. And let me, clarify it a little bit further with a funny example, right? Okay, so suppose that you absolutely have to determine, what fraction of dinosaurs could fly, right? And you know nothing about dinosaurs, right? So we'll say, well, in this case, what's a reasonable assumption? You just take an average dinosaur, right? So on the left, there is like an average dinosaur, and there are like butterfly wings on one of them, right? So you don't know much, right? Everything looks the same to you. So then you become a paleontologist, and you discover that there are these giant dinosaurs that walk on 4 legs and don't have any wings, and they obviously cannot fly. And also there are the other type of dinosaurs that eventually became modern birds, right? So you say, okay, well, now I can count, right? Now I can go and see how many species of dinosaurs could fly and how many species could not fly, so I can answer that question. So Bayesian approach begins from what a risk manager will call a proxy, right? And gradually improves as the more data becomes available. And in Bayesian reasoning, right, in Bayesian inference, called Bayesian inference, there's your initial belief is called the prior, your final belief is called the posterior, and evidence or likelihood is what moves you from prior to the posterior. So you assume something, you see some data arrive, you adjust what you think, and your data helps you eventually become, your posterior to become accurate, is your knowledge to become accurate. So the key difference here is that between frequentist and Bayesian is that frequentist and Bayesian probability statisticians will arrive at the same conclusion when they're dealing with an easy problem. So when, for example, there's a dice, anything that happens very frequently, a frequentist and Bayesian statistician, they both will arrive at the correct conclusion. The difference there is that if we're talking about an event that does not happen frequently enough, or did not even happen yet, Bayesian statistician will venture a guess, and then will improve this guess as more data arrives. Frequentist statistician will throw their hands up and say, I don't know. And that's actually not good, because as a risk manager, you don't have an option of not modeling risk, right? So for example, let's say you're in a currency that never had near zero interest rates, right? But all of a sudden they become near zero. In a currency that never had negative rates, and all of a sudden they become negative. You don't know what's going to happen, right? For example, US dollar, right? Back again in the 90s or early 2000s, Japan was the only currency with near zero rates. There are no other currencies with near zero rates. So now, if you're doing risk in US dollar or euro, you would say, well, near zero rates have not occurred yet, but they might. Now, imagine that you wake up and interest rates dropped, but they never like that, they're never at this level in the past. If you're using frequentist approach to risk, you throw your hands up and say, well, I don't know, I cannot use risk, right? Or you say, well, I'm going to use historical, which actually is patently incorrect, right? Because essentially you're using probability distribution from a different state of the market compared to what the state of the market is today. If you're Bayesian, you say, well, if I don't know anything, I'm just going to assume equal probability, right? So for example, if I'm asked what fraction of dinosaurs could fly, I would say, well, I'll start from 50%, because what happens is that if you don't know anything, you don't want to start from 90-10 or 99-1, because if you're wrong, it will take a lot of evidence to get you to the right place. So if you know nothing, you should just assume equal probability, right? You should assume the average, because that's the starting point from which minimal evidence will get you to the way you want to be. So that's what we're going to do here with currencies, right? So just giving you a little bit preview of where I'm going with that. Right, so we will discover that this data set covers the entire range of interest rates. However, it does not currently cover the entire range of interest rates for every currency. Some currencies have high rates, some currencies have low rates. So for each individual currency, there is incomplete data. For the whole data set, there is complete data. So we're going to discover how to build a model that uses other currencies to extend the data where it's not available for your specific currency, but use the data from your specific currency where it exists. And if you start from a currency for a country where there's no data, what will happen is that initially it will give you the average, right? It will say, well, everything else is a proxy. You can maybe select, a group of currencies, like for example, you can say, well, it's G20 is my proxy, right? If one of these currencies is where I don't have the data. But essentially, whatever group you're using, your proxy is the average. As you get more data, your proxy will start being less important, and your specific currency becoming more important. And you will see that the model is gradually adjusting and becoming closer to the individual currency. So that's kind of all, basically very inspirational kind of hope that this will happen. So the good thing is that we will be able to see it happening in on our computers with Python in the second hour. So we build a model that actually does exactly that, and we'll be able to prove it by feeding it the data that we generated ourselves. And then we'll see that it also does a very similar thing for the historical data set. All right, so now model construction. So before, given us a workshop format, and we have 2 days, and I think that, it's not the end of the world if we perhaps given that we need to set up with Python and so forth, maybe a little bit of generative. Sorry, but a little bit of regression models maybe will be tomorrow as well. So let me just ask for questions in the middle. I don't want to wait until the end. Any questions so far? Anybody will ask, raise your hand to ask a question? By the way, if anybody has hands raised about the doing Python, then please lower them so I can see what the questions are. Or you can also put them in the chat, and my colleagues will alert me if there is anything in the chat that I need to look at. Questions so far? Okay, we're good, right? So excellent. So let's continue. Model construction. Okay, so model construction with machine learning is a little bit different from traditional model construction, because what we're used to is a stochastic differential equation. In here, we don't have a stochastic differential equation, right? So when you're thinking about risk model or derivatives pricing model, first thing you're thinking about is the equation, right? How many drivers it has, how many stochastic drivers, is it normal, is it log normal, is it square root, does it have stochastic volatility? So you're thinking about stochastic differential equation and the shocks, right? So dz term that drives that equation. You also should be thinking about the drift. However, drift is, we'll discuss a little bit later. Drift is often an afterthought, and the reason is that most of these models were built at the time where only short horizons were important, and for short horizons, volatility is a lot more important than drift. Here, we're interested in longer time horizons, so actually drift is just as important. In fact, it is the drift that will help us to understand what the model does. So we're going to look at the model that does not have a stochastic differential equation. It will not have the risk drivers. It will work directly with the probability distribution. Today, we're looking at regression models, where we will be looking at averages taken over these probability distributions. And we will be modeling directly these averages. For example, we're going to model mean of future risk factor value, which is what exactly the drift is. Right? So in other words, if today the interest rate is 5%, there is a probability distribution of future values, and the weighted average of this probability distribution is at 4%, then I have a drift of -1%. So we will be looking at regression of parameters of future probability distribution. Tomorrow, we will be building generative models, which can actually sample from the probability distribution. So in machine learning, as you may have heard, that models are classified in generative and discriminative, and that's actually kind of it's really the right way to classify them as in generative and everything else, right? Because not all of the non-generative models are classifiers. In fact, regression models are not, and they only classifiers in a very loose sense. So the difference between generative models and the rest is that generative models are able to generate new samples, and there are models that can, and there are models that cannot. So today we'll be talking about regression models, which are not able to generate new samples. There are also actually some generative models that we can use for regression. They can generate new samples, but we're not going to rely on them. We're not going to use them for generating samples, right? We're going to use them for the regression. However, the models we'll use today, which is a feedforward network, is not able to generate new samples, but it's able to take averages over the probability distribution, which is what we want. We'll be looking at drift today. Actually, you can build exactly the same model for the volatility. So if your objective is to estimate the volatility, you can do absolutely the same thing. And in fact, you can take the source code that's on GitHub and probably about 10 lines of code change, and it's going to be estimating the volatility for you. All right, now, excuse me. How do we define the model, right? So, well, if there's no SDE, so what do we have, right? What are we trying to compute if we're not trying to compute parameters of the stochastic differential equation? All right, well, what we're trying to compute is this probability, right? So let X be a complete set of model state variables such that the model is stationary and Markovian in X, right? So I'm right there making two strong assumptions about what kind of model I'd like to build. So I'd like to build a stationary model, Meaning that you know how you have you know, when you, let's say, have a risk neutral model and you're calibrating the two prices, it has term structure of parameters. And the reason is that a trader who is trading, let's say, a 10-year, or group of traders who are trading, let's say, 10 or 30-year bonds, they have some different views, you know, about basically what the rates would go, right? So what it means is that there are different assumptions looking at different maturities. And the thing is, this is phenomena is, you know, it's very specific to pricing, right? So the term structure is very specific to pricing. Evidence shows that if you have a trader, if you build the yield curve and say, hey, you know, forward rate at 10 years is, you know, basically there's you know, it goes a little flat and then goes a little bit steeper, or it goes very steep and then goes flat, right, depending on what the shape is. And you say, well, you know, just watch it, right? So the forward rate will do the same thing. So you know, so you have the shape of the yield curve. You say, just watch, the interest rates will go, you know, the same trajectory. Okay, so this is wrong on two levels. First of all, that's a risk neutral measure. The only reason yield curve is upward sloping is because of the market price of risk. The longer you hold, the more risk you have. So short dated interest rates are lower on average. They can be higher, so yield curve can become inverted, but on average, they're lower than long dated interest rates. So for example, our 3-month rate in this data set will be a lot lower than the 10-year data set, and not just because of credit and liquidity, right? It's just because of the, I'm talking about interest rate risk has to do with risking, you know, basically volatility of interest rates, right, or bond prices. The longer the maturity, the more volatile is the bond, the more you have to pay for risk. So what happens there is that today's forward rate, 30 years in the future, 30 years later will become the short rate, right? In other words, today's, or rather, you know, 30 years later, they will be borrowing for 3 months. That today's, you know, forward rate from 30 years to 30 years and a quarter, but you wait 30 years, it's going to be your short rate. When it becomes the short rate, even if the yield curve today is upward sloping, it will not be at that level. It's just risk neutral measure, right? So in other words, as you're approaching the date, it will come down. So first of all, whatever traders think about the rates, they price this rates differently because of the market price of risk. And that's something that only happens in risk neutral measure. Real world models, like models for risk, like we're building here for things like limits, for insurance, you know, for asset liability management, for the macro, you know, it's real world measure. So that immediately goes away. Right now, second thing is that the traders are pricing bonds in the way that they're pricing bonds, not only because of the market price of risk, but also because they think the rates will go up and down. So the shape of the yield curve is determined by two factors: what the traders think of risk, and what the traders think about risk, and what the traders think about what the rates would go. And these two things are added together to determine the shape of the yield curve. Now, the thing is, the traders are very fickle, right? So if the trader today thinks that in 10 years, the rates will do something, it's very important for pricing these bonds today correctly. But you know what? 10 years later, this trader will be, you know, will basically retire, will get promoted to a manager, will be another trader. And this another trader will think something else. So the model is stationary. You know, you should not think it's some sort of a shortcoming, because it really should be stationary for historical. Today's time period is really should be, we shouldn't build a model that says today's time period is special, right? There are a lot of models, for example, the risk neutral measure, in which volatility is consistently just has a downward trend, right? So volatility today is higher than the volatility for the 10-year horizon, right? If you look at the swaption matrix, it has a particular, you know, shape where basically for longer maturities, there is a trend. And then year after year, it's the same trend, right? So now it's 10 years passes, and the volatility is still at the same level it was, but 10-year volatility, which used to be 20 years, now it's 10-year, and it's now lower. So in other words, term structure calibration is in the realm of risk neutral. We're building real world model. So if you're like I am, coming from the pricing side, right? So for basically thinking about risk neutral pricing model, you should, you know, realize that it's very important to realize that this term structure that we're all used to calibrating and building a curve is really something that only makes sense in risk neutral measure, and real world models, you know, should really be stationary. Yeah. Now, second thing is that you know, what is the Markovian mean, right? So these things are actually different. So Markovian means it does not depend on the history beyond of what's captured in the state variable. So if I am at time t and I have state variable, for example, today's interest rate, x, And I would like to look at the probability distribution of the same state variable, but at a future time. It only depends on today's state variable, future state variable, and the difference in time. By the way, in historical VAR, what you're assuming, it also only depends on the difference between the risk factors. So that's a critical difference. In historical VAR, this probability depends on the difference between risk factors. In our model, it will depend on each risk factor separately, but only on the difference in time. That's what makes it the fact that it only depends on this x and not any prior time makes it Markovian, and the fact that it depends only on this time difference makes it stationary. So because we're using this form and we're not replacing it by p of x t prime minus x, that's what helps us to not only capture correlation, but also co-integration. So co-integration, when two risk factors move not necessarily in correlated fashion, but cannot get too far from each other, sort of like some person walking a dog on a long leash, right? So the dog can roam around, and the movement of the dog is not correlated with the steps of the person, but the dog cannot get very far. So it's just like, the interest rates, short and long interest rates, they're correlated only maybe 10 or 20%. If you build a geometric Brownian motion model which has 10% correlation, they will just diverge from each other. But no, the yield curve slope is constrained. It cannot be very steep in either direction. So that's what also makes a model superior in a sense to historical simulation. All right, so now for the finite time definition, right? Why are we not going to go to continuous time? Okay, the reason we don't go to continuous time is because it only helps us for the stochastic differential equation. Stochastic differential equation is defined in continuous time. That's what makes it differential. And that's what helps to make it analytically tractable, right? It helps to solve it analytically, helps to work with it. So here, it actually completely counterproductive in a sense that it actually hurts, right? So you calibrate to a finite horizon, in our case, 5 years. You use the model for 5 years or 10 years or longer horizon, right? And going to infinitesimal continuous time parameters and then going back to finite horizon when we're not using analytical parametric formula, it has no benefit, and actually causes accumulation of numerical error. So we're going to multiply the model at nodes which are whole multiples of its calibration horizon. Okay, now between the nodes, you can interpolate using stochastic methods. Brownian bridge is the old method that was 20 years old, very well studied and proven. Also, there are machine learning methods which are called market generators, which basically help you recover, essentially interpolate consistently with statistics of your time series. So we're not going to go into that. We don't have time in this workshop. And also, I don't know, if we will have the opportunity to show how the model works for multiple time steps. If we go very fast today and tomorrow, then maybe at the end of tomorrow's session, we'll get to that. But for now, we're just going to build a model for the 5-year horizon and stop at that. But the real purpose of the model is then to apply it to 10, 15, and so forth year horizon. So when we build a model, when we know what happens at the 5-year horizon, we can use it twice and get to 10-year horizon. We can use it 3 times and get to 15-year horizon and so forth. So building a model for a given time horizon gives it all of the other longer horizons. All right, and any questions? Okay, so one thing I wanted to ask is that I don't want to be constantly looking at the chat to the side. So, I would like to ask my colleagues, Anastasia and Andrew. So if someone is asking a question in the chat, please just send me. We have a separate chat just for coordinating the coding. So please send me a message in the separate chat. I'll be able to, or just raise your voice and alert me. So at that point, I will not be looking at the chat myself. So please keep looking at it. Okay, so now what kind of models we can build? Okay, so the models, as we've discovered, we don't have the stochastic differential equation yet, but what we do have is state variables. So just like in traditional quant risk models, the model is determined by the stochastic differential equation. Machine learning models are determined by what the state variables are, right? So state variables in machine learning, they're the same as features, right? So in other words, these are the inputs that you provide, and input features are risk factors that you provide to the model. Output features are risk factors that you would like to predict. And if you have a regression model, you're predicting their averages of the, basically averages on top of the probability distribution, for example, mean or standard deviation, which gives you the volatility. If you have a generative model, you just draw directly from the sample. But it's really the state variable that makes your model what it is. So there are two ways to choose state variable. So you can either choose state variables that slide forward with you as you move forward in time, right? So this example shows a model in which your state variable is the short rate R. So I will use the short rate R, and I will use for the long 10-year rate, I use S, because when I'm calibrating to swaps, it will be the swap rate for the 10. It will be term 10-year swap rate, or 30 or whatever the swap rate is, right? So you will hear it's bonds, right, but still using S. So R, think of it as a short rate, which is a standard, a standard symbol for the short rate, and S is the term rate, right? So it's a rate, for example, 10-year. It could be the bond yield, or it could be the swap rate. And if we're going to talk about forward rates, which is not, we cannot build the forward curve from this OECD data set, but if we had swaps, we would, for the forward rates, we would use F. So one choice of model is where your state variables slide forward with the scale of time, right? So they move forward. So you can look at this example here. So you have the short rate at 0, and 10 years later, you have the swap rate or bond rate for bond yield for 10 years. You moved to tau, right? And tau is a model horizon. In our coding, we'll use tau of 5 years. So with tau, model horizon tau, you will move here. So your short rate will be again. So if you wait 5 years, your short rate will be the rate between 5 years and 5 years and 3 months, right? So when you get there, it will be between today and 3 months later. And the 10-year rate will become the rate that today, basically, it's the rate that will become this rate that will become your state variable. Then today is the rate between 5 years and 15 years, and it will become the rate between 0 and 5. So essentially, you can think of it this way, right? So you're with each passing day, you're always looking at the short rate, and you're always looking at the 10-year bond price, bond yield, right? These maturities remain the same as you move forward. So this model with these state variables is actually the perfect counterpart. In fact, it's exactly equivalent in terms of state variables to short rate models, 1-factor, 2-factor, right? So things like Holland-White, Krasinski, CR++, G2, or 2-factor counterparts, which are G2 and CR2++. And these models, traditional models, they're called short rate because of the stochastic drivers that drive the short rate. It doesn't mean that the short rate is the only state variable. For 1-factor model, they do have one state variable, and short rate is that state variable. However, for 2-factor short rate models, they actually do have 2 state variables, and you can choose them as being one of them has to be the short rate. I don't have, unfortunately, time in the format of this workshop to explain exactly why. It's very fascinating, but basically the model will blow up if you don't include the short rate among the state variables. However, you can choose any other term rate as the other state variable. It does not have to be this x1, x2 that you're used to in G2 model or CR2++ model. It can be the short rate and the term rate, right? So this machine learning model that we will be building is essentially like a machine learning counterpart of G2 and CR2++ in the sense that it shares the same state variables. Okay, there is another model we can build, which I will mention for completeness. However, in our data set, we just don't have all of the yield curve points which you need to build it. So you can only build it for things like swap rates, or if you have the entire set of bonds, which OECD data set unfortunately does not. So this model is a forward rate model. So it can be whatever forward rate. It can be any forward rate for borrowing of any kind, right? So it could be a deposit rate, it could be a swap rate, or it could be a bond rate. So forward rate model is not like LMM, which only works with deposit rates, right? It could be, it's more like Sabre, where it could be any underlying. In fact, for Sabre, underlying sometimes is not even a rate, right? So it could be deposit, swap rate, or bond yield. So this model is kind of the machine learning counterpart of LMM if we're talking about deposit rates, but it also could be a machine learning counterpart of the swap market model if we're talking about the swap rates. The key distinction here is that as you're moving forward in time, your state variable stays in place, right? So in other words, in this model, your state variable is the forward rate between this time t and time t plus tau, right? So for example, this is 10 years and this is 15 years. As you get closer and closer, this rate stays the same, right? Unlike on the previous slide, unlike on the previous slide, where your state variables were moving forward with you, right? So here the state variables stay. And how do you know the difference? You know the difference between, because for the forward rate models, such as SABRE, LMM, or similar models, your state variable eventually have to retire it because you get to its fixing and then it doesn't change anymore. So for models like LMM, you know that when you build a model, you have a state variable, you move toward it, you reach the fixing date, and then at that point you retire that variable, and the next variable becomes your main variable, the first variable. So it's a forward style model if you periodically have to retire your state variable when you reach the fixing date. With this model, you never reach the fixing date because it moves away from you as the time goes forward. So here there are some slight differences in how this probability is built again. So if you at my talk on Monday, actually that's something I did cover there, but it's not relevant to the workshop, so I'll just continue. But if anybody has a question, I'd like to further clarification, I'm certainly happy to answer, but I'll keep moving just in the interest of time. All right, so now I'm getting to the most interesting part, right? It's collaboration to multi-currency data sets. So collaboration to multi-currency data sets, right, is something that to me as a quant is completely jarring and alien. I mean, it's really very, something kind of very ingrained in your quant training that you don't calibrate to multiple currencies, right? So people do actually calibrate to multiple credits. So I think for credit quant, when you say, well, I'm going to use a proxy because I don't have enough data for this particular name, they say, yeah, makes sense, right? Because people have to do credit calculations for some names that actually have very thinly traded CDS or don't have any traded CDS, and you have to look at bonds. So for credit quant, what I'm doing is actually kind of a lot more perhaps familiar and wouldn't really cause anyone to think twice. For interest rate quant, saying I'm going to use data for, let's say, Australian dollar, New Zealand dollar, and the Sweden kroner, to calibrate my euro, interest rate model. That's a completely bizarre notion. However, as we will discover in a moment, it's only a bizarre notion because traditional statistical modeling techniques are not able to do that. And with machine learning, you actually can. And not only we can, but also we can prove, not only we think we can, but we can prove we can because we can generate a data set with the properties that we know. And we will work with it actually 1 hour from now, within the next hour. Then use machine learning to discover its properties and confirm that they're the same as we put in the generator. So why can't we use single currency data? Of course, it's preferred because if you have enough data for a single currency, then you get the most accurate model from that currency. The problem is that if you look at 5-year horizon, you just don't have enough data point, right? So we covered that already. If you have 5-year horizon, you go back 25 years, you only have 5 data points. That's not enough. All right, now the data, of course, is sufficient if you take all of the currencies. There are tens of currencies. If you take one currency, here's what you get, right? And actually, I would like to introduce this chart. I have a little bit further an explanation of how this chart, to read this chart, but that can wait a little bit. But for now, I just want to introduce this type of a chart because, my co-author, Alexey Kondratev, I think really, did a lot of, basically should be credited with popularizing this type of chart. And I found it extremely useful for building machine learning models. It perhaps is not as useful if you're building traditional models, but for machine learning models, especially models that you care, where you care about co-integration, right? Very long horizons where you don't just care about correlation, namely movements of risk factors, you care about where they ended up in relative to each other. So that's actually a brilliant type of chart. So let me show it, right? So the way the chart works is that you have the, by the way, ST-int is the short-term interest rate. So that's the that's the symbol, that's a ticker in OECD data set for the 3-month rate. And LT-int, which I occasionally use in some charts. So LT-int is long-term interest rates. That's a ticker within OECD data set for the 10-year bond yield. So this is the short rate in percent. And this is the short rate after 30 years, also in percent. Okay, and what you see here is is basically, if you look at this, right, you can see that short rate initial was very widely varying, right? So here along this axis, that's the short rate 30 years ago, or rather, each of these points is a span of 30 years. x-axis is where the rate started, y-axis is where the rate ended, right? So for example, this particular point, the rate was 18%, it ended near 0. Okay, what the hell happened here, right? Well, again, so, you know, I'm still remember, even though at that time I was in the Soviet Union, so, you know, I only heard about it, that in the US, there was a lot of inflation back in the 80s, right? Soviet government, of course, was making sure it's all in the newspapers so people know how people are suffering under the capitalist regime. So that inflation lasted, you know, probably around a decade, right? And then the interest rates have come down gradually, right? So they, you know, there was a 1 year period, I think 1 year, a very short period when the rates really hit very high levels. The central bank successfully fought it. But there was longer time period where around 10 or 15%. And there was, of course, you know, when in the 90s, you remember, you know, your checking account used to pay about 5% if you were in the US at the time. So that's this range, right? However, what happens here is that on the y-axis is where it ended up. And it ended up at 0 because the interest rates have been near 0 for the past 2 decades, right? So they went very low after the dot-com crisis, then they went up at the financial crisis, and then they went down again. And just as they started inching up, COVID happened, and then again the central bank started doing things like quantitative easing, which used to be called throwing money from the helicopter. But you know, with Bernanke retired, it's no longer, you know, the fashionable way to describe it. So they're essentially printing money, driving the interest rates down. So interest rates in the past period are near 0. In the 30-year earlier period, they're very high. So essentially, you're just concluding the interest rates always go down, right? Looking at this, and you cannot, right? So that's the, you know, that's how it looks. You know, that's basically what helps you understand why it's happening like that, right? So you count 30 years from that period, right? And you get here. And if you go further down, you run out of your time series. Okay, well, for 1 year, it looks a lot more reasonable, right? So if the data is around this red line, it can be above or below, right? So below means the rates went down, above means the rates went up. So that makes sense, right? And on average, if it's around the center, it means that the drift is smaller than the volatility. Okay, and what also we know is that the volatility at very low interest rates is small. Well, because if you're near 0, at least in the negative direction, there's not much you can do. In the positive direction, also, there's not much you can do. There is something called the liquidity trap, right? So liquidity trap is when the rates get stuck at 0 and nobody can get them out of there, even if they want, right? You know, economists compared to pushing on a string. So liquidity trap means that volatility, well, it's not really volatility effect, right? So in other words, the mechanism for it is not volatility related, but if you try to measure volatility, you will conclude that the volatility is 0, and that's what we see here, right? Here's bigger, and here's even bigger. All right, well, now what is this thing, right? So, well, that's actually, there's a pretty old gap in the data. So in fact, you know, people say, well, I have a gap in my data. That's a kind of a visual gap in the data. You know, it's very funny that that you can actually such a literal gap. So what happens here is that there was a time period in which basically this edge of that square is when the end of the period is when the rates were really low. This edge is when the start of the period when the rates are low. So what happens there is that when you have two regimes, right, when you're stuck in near 0 in liquidity trap, and then the rate jumps all the way to 5% and stays there. So it's kind of, you know, it basically either here or there. So when it's switching, it's regime switching, right? You get the square because essentially you like, you know, when you have a period of start and end, if you're doing historical VAR, you trace, right? So you trace this rate. Do you see me on the video, by the way? Do I need to stop sharing the screen? Or just stop sharing for a second? I want to. Sorry, can someone comment if you see me in the video? Next to the screen? Everybody on mute? Okay, now I'm getting really worried, so let's take a second. Anybody wants to pour some coffee? I just want to make sure that I'm not speaking in vacuum. Perhaps I'm already disconnected. No, I'm good.
No, we can hear you.
Yeah, okay, yeah. So it actually, if it's you, please periodically just, you know, unmute yourself and just saying something just someone else, because there was a, you know, huge storm here. So basically, if I lose internet connection, I may not discover it until, you know, until later. So it will be very reassuring to me to know that I'm still online. So what happens here, do you see my video next to the screen, or you don't?
Yeah, we see it.
Okay, right. So basically, there are two rate levels. So you trace it like, you know, started here, ends here, right? Then it switches like this, right? Then it switches like that. So essentially, every time it switches, you trace an edge of that square. So that's actually a completely reasonable effect, right? Okay, now what happens at, like, imagine that you are here, right? Imagine that your starting point is 3% and 3% flat yield curve. You don't have any data, right? So in other words, this comes back to this whole frequencies versus Bayesian risk manager, right? A frequencies risk manager faced with a pretty reasonable, interest rate level of 3% short rate and 3% long rate flat yield curve, a 3% level, that actually happens all the time in other currencies, but not in this currency. So basically, a frequencies risk manager will say, hey, never happened before. I cannot really say, I don't know what the risk is. And that will not be met, I think, with positively by the board. So a Bayesian risk manager who will build a machine learning model will say, no problem, because I will have data from other currency to cover that gap. And if United States rates will eventually end up here, then this data will appear and the model will adjust itself to rely on US data and will no longer rely as much on other currencies. So that is, in a nutshell, what we're trying to accomplish, right? So we have gaps in data for a single currency. We want a model that matches or respects the data that we do have and augments this data with assumptions or model, basically with interpolation, extrapolation that comes from other kinds, that's informed by the currencies where we have gaps in the data. So that's what we're trying to accomplish. And you cannot do it with, first of all, with historical Monte Carlo, because frequencies, you cannot even do it at all. It's just the whole paradigm is wrong for that. With Bayesian, you would like to with the conventional statistical techniques, but you cannot. So you can only use machine learning. And the reason is that we need to deal with the multi-currency data sets. Okay, so let me talk a little bit about multi-currency data sets. So essentially what we are trying to do here is that you have the initial point, right? That's the short rate, that's the 10-year rate. For each currency, you ended up somewhere here, right? So this currency, you started here. So imagine that this is the the previous chart is this plane, right? So the vertical plane. So this plane that I'm tracing with the mouse right now is the previous chart. So imagine that we're starting from the gap, right? Well, our currency didn't have a starting point here, but other currencies did, and they ended up somewhere. So what we'd like to do is to, for each given currency, we'd like to have a kind of a bell-shaped continuous probability distribution that we need to recover from this data. Okay, now in order to do that, right, we need to do encoding of currency, right? So in other words, a model, unlike traditional quant models for the interest rates, will have currency as the explicit parameter. And that's called, in machine learning, it's called a categorical variable, right? So a categorical variable is the, categorical variable is the type of variable that has distinct values, right? So it's color, something like that. And there are some categorical variables that have natural order, right? Maybe they're not actually, strictly speaking, they're not actually called categorical, they're called discrete. For example, credit rating, right? So credit rating has a natural order, so it has distinct values, but you know that, default, then there is, C, B, and so forth, right? And there's AAA on the other end. So now currency, just like color, it does not, well, color actually also have natural order, the rainbow, right? If you're a physicist, otherwise it doesn't. But currency, they don't really have a natural order, right? Well, you can, if you're an economist, you can really say, oh, well, I'm going to group euro and dollar on one end and some currencies that are prone to hyperinflation on the other end. But we're trying to build quant models. The thing is, the quant models, they don't rely on econometric data. In finance, generally, it's not, in risk management, usually for various verification or, basically subjectivity reasons and so forth, usually fundamental economics data is rarely used in risk models in quant finance, right? Even though it's certainly possible. So I'm not considering things like, well, let's sort it by the GDP and so forth. Also, as we have discovered in our work, when you build a machine learning model on unlabeled data, right? In other words, where currencies were all kind of in one bucket, and we didn't really make any currency different, treat any currency different from any other currency. We discovered it's not really related to GDP. There are some very strange neighbors there that have similar dynamics in really very different countries. So we cannot put them in order, right? So in other words, it's not a three-dimensional model, right? It's not the model in which there's the short rate, the long rate, and the currency axis, right? It's not a three-dimensional. It's not going from 2 to 3 dimensions. It's going from 2 to 18 dimensions if there are 16 currencies. The reason I say 16 is because this data set that we're going to work with shortly is it has 16 currencies. It has 48 currencies, but 16 for which there is enough length of the data. So and here I'm talking about currencies because the model applies to swaps as well as bonds, but really for bonds you should be talking about countries. All right, so this is an 18-dimensional model, right? Short rate, long rate, and 18 currencies. And this approach to encoding the currency as a separate axis is called one hot encoding. So essentially, each currency is an axis in which if the data is for that currency, you put 1, otherwise you put 0. So all of your data is at, if you have a hypercube, which is 16 dimensions, you don't have any data at 0. All of your data is one edge from the origin, and you have 16 edges because you own 16 dimensions, right? In 3 dimensions, the cube has three edges coming from 0. In 16 dimensions, the cube has 16 edges coming from 0. All of the data is equidistant to origin, exactly 1 edge away. That makes each currency equivalent. That's the only way actually you can show that. That's the only way to make them equivalent. You're not favoring any currency as being a neighbor or far away, basically, or close to another currency. They're all equidistant. So I'm not assuming that currency 1 is similar to currency 2 or currency 2 to currency 3. So that's the essence of unsupervised learning. I don't assign any labels to the data. If I start assigning labels, that becomes supervised learning. It's also actually the model you can build. It's just not the model that we'll be building today. You can say, okay, I'm going to say GDP. I'm going to put, all kinds of other things. And then perhaps I'll be able to find some sense or some order in my data by analyzing, basically all of these factors. However, what we're doing is complete unlabeled, right? So unlabeled, unsupervised learning on unlabeled data. We're just going to know the currencies are different, but we don't know what which ones are similar. So what we're looking to do is to find a hidden so it's basically find the latent variables in a space. The space is not really 16 dimensionals. If it was, machine learning wouldn't help us. There is a structure in it. It's just the structure is something for traditional statistics is very difficult to discover, because traditional statistical techniques, they work worse and worse the higher the number of dimensions is, right? Because in multidimensional space, it's weird. I mean, it's very funny space. Like, for example, in multidimensional space, almost everything is equidistant, right? So now there's really very hard to define a neighbor, right? If you put random points, almost all of them have similar distance to each other. So this space, which is very hard to imagine, it's very challenging for the traditional statistics, but not for machine learning. And that's what makes it so powerful. So we're going to find a latent dimension, right? So in other words, you can think of it this way. Imagine that there was some type of a characteristic. Let's say it may be, it's not actually GDP, but sort of GDP-like that economist would come up. And that characteristic would be magically telling us what the mean reversion target is, right? You'll be able to say, well, depending on this some economic variable, right? You put GDP and you plug GDP in, you put whatever, population, per capita, various, per capita measures, of the economy, and then say, okay, so, well, if this number is low, the mean reversion target of the interest rate is, let's say, 3%. If it's high, it's 10%. Okay, so that would be, an amazing feat of economics. However, nobody has come up with that. So we're going to let the data dictate it, right? So in other words, a model will tell us that what this variable is, and you can measure it. How do you measure it? You measure it from the result, right? So in other words, you measure for each currency the mean reversion target, and then you order it. And you say, okay, so these currencies are on one end, they have low mean reversion target, other currencies have high mean reversion target, right? And, that's essentially what unsupervised learning is, right? So it will basically do the job of the economist to us and figure out from the data that we do have what currencies are similar. Right, so so this is essentially what it does. Like in images, I think there was a very famous case that you may have heard of, where machine learning. That's one of the successes that I think really made help people to take machine learning seriously. Is that given a bunch of images of pets, machine learning was able, unlabeled, right? Machine learning was able to say, hey, there are various pets here. They all look different, but there are two kinds, right? Here's the first kind, and here's the second kind. The first kind is dogs, right? And second is cats. The thing is, well, cats are cats could look very different, but dogs can really, like Chihuahua is definitely very different, from a Rottweiler. And the thing is, machine learning was still able to say, well, these two pets, which look very different, they have one is 10 times the weight of the other, right? It has giant teeth. and say, well, there's something in common to them, and that's actually being a dog. So machine learning doesn't know about the dog, but it knows that these things are similar. So same thing is that it doesn't know about GDP, per capita or any other economics. It's just saying, well, these two currencies, they have similar interest rate dynamics, right? So that's exactly what we're trying to accomplish here. Right now, how do we deal with overfitting and underfitting? So, well, it's very similar to actually that one is one way in which machine learning is similar to traditional statistics, because you have excuse me, you have the risk of overfitting and risk of underfitting. And if you're building a yield curve, for example, it's the same thing, right? So if you're underfitting, you put the straight line through all of the yield curve points, and you obviously misprice some bonds. Or you put an oscillation. Basically, you interpolate the yield curve such that it oscillates to each point, and then you have wild variations, swings and hedges. So neither of this is good. So similar here, right? So in other words, you basically either can have underfitting where you put a straight line, so all of these animals start looking the same. In our case, in application, as applied to our model, it would just basically predict, it will come up with the model for the average currency. We don't want it to happen, right? Because if we wanted a model for the average currency, we would just put all of the data together, right? So underfitting in our case is that it stops depending on currency. Now, overfitting is that for the currency that does not have enough data, it produces some crazy predictions. So we don't want that to happen, right? So you can do overfitting and underfitting here as well. It just, manifested a little bit differently, but the concept is the same. Right. So now latent dimensions, right? So so again, that's my final kind of inspirational, machine learning slide before we get to finance. So this is a very interesting example, right? Which actually also illustrates what we're doing. So this is the original face of an actress. Actually, I'm trying to find out the name. I don't know if anybody can know the name. Please type me in the chat, because people were asking me who this actress is, and I don't know. So you start from this face and use a library of faces of various, people smiling. And some people smile with the mouth open, some people smile with the mouth closed, right? And some people frown and some people smile. You're able to then start from this face and generate various smiles with open and closed mouths. And then if you ask this actress to smile, you will see that it actually looks very similar. Well, you can see it looks realistic, yeah. So you don't have to compare to real pictures to see that that's an accurate representation of the smile. So what this does is that this library, we don't know, this is just one face, right? This library tells us how wide the mouth can open, right? How much the ends of your mouth can go up and down. So it's exactly the same thing here, right? So if this is our initial interest rates and we don't have the data, it will tell us, well, okay, so a lot of the currencies, I know that the interest rates from here can go like here, but not here, but not there, right? So that's what we will be doing for currencies that don't have the data, right? We still will produce something from their starting point, something average, right? And then as the data starts arriving, if we, for example, sometimes in finance, there are very often situations where there are new currencies, like for example, some new currency was introduced, right? And you don't know how it will behave. And as you go forward, you get more and more data. So in the beginning, you want a proxy. And then as the data arrives, you want your proxy to eventually become the single currency model gradually, right? So that's what this will do. So with that, let me now go to something more resembling to a typical workshop. But I think it was very important that, just as I, at this final few slides before we go to the hands-on practical session, I think it's very important to understand what you're trying to model, how you can model, and also how you cannot model it. And generally, what is the problem that you're trying to solve? And that informs your decisions about what kind of machine learning architecture you'll be using. You're saying, well, I have this model, so I'm just going to basically go over TensorFlow and just, try various things out there. That's not going to work. So please, rest assured that everything I was talking about before was critical to properly selecting the neural network architecture and having a successful model. So that's, was very important to understand in order for us to build a model. Okay, so what are we going to do with the model, right? So again, so today is the regression session. Tomorrow we'll have the generative session. So today we will not be generating anything. We'll be calculating averages over probability distribution. So our input is today's interest rate. Output is not a sample, right? So it's a single output. That's the average, or it may be the volatility. I'm looking at the drift. We can do the volatility. So if you today have minus 50, let's say it's a euro, or whatever, some currency that has negative rates, right? You have minus 50 basis point interest rate, short interest rate. That's R is a short rate, and 3% 10-year rate, right? That's your initial state variable. You go to, well, DNN is a deep neural network. Actually, the network we will build here will not be so deep. It will be a little deeper when we go to 2 dimensions, but I don't know if I actually be able to get to it perhaps tomorrow. But I just call it deep neural network. I could call it just ANN, which is artificial neural network. Okay, and it will produce, again, not samples, but average, right? So it will say from here, on average, you get 2% because there's mean reversion, right? So if mean reversion is high, you'll have upward drift. So you can say that the mean is 2% for the short rate and 5% for the 10-year rate. So that's our state variable in the beginning. That's a state variable in the end. Now, as an additional input here, we have the currency. And one hot encoded currency requires one input per currency. So if there are 16 currencies here, only one of them for each input will have a 1, right? So in other words, each data point, and data points are organized in something in machine learning called a sample. So sample is the list of data. Basically, sample is a list of vectors of features. So feature is any observable that you either use as input or output. And this vector consists of 2 rates or 1 rate, depending on if you're building one rate or 2 rate model. Excuse me. And 16 values which have 0 and 1, can only take 16 basically are the inputs which can only take values of 0 and 1, and only one of them is 1 at a time. And note that I have it here, but not here. Why? Well, because the currency is just not going to transform itself. There's no alchemist stone that basically if you invest in a euro, then end up with a dollar, right? So in other words, you have transition from one level of rates to another level of rates for the currency, but you don't have transition from one currency to another. So this is a parameter to the input, right? But it's not an output. We know with output it's the same, right? That's why it's not an output. And it's not the same, like for example, for credit transitions, right? So the you have initial rating and the final rating. And so that's different in this case. But here the currency does not change. All right. So now how are we going to do it, right? So we're going to start. So first of all, there are 2 different architectures here, one for the regression model and the other one for the generative model. For the regression model, it looks more like a traditional neural network that you're very used to, where inputs are coming from one end, outputs are coming out from the other opposite end. And there are some hidden layers in between. The generative network that I will be talking about in the next presentation, the restricted Boltzmann machine, is actually different because the inputs and outputs are on the same end, and they go and circle back to the hidden layer and come back, right? So, but this is not RBM yet. This is just a feedforward network. And it has an input, which in this case is a short rate plus the currencies, a couple of hidden layers, 1 or 2, right? And then output, which is just one value. It's a mean for this value, right? I could actually predict a couple of things, right? So I can start predicting volatility, for example, right? In fact, I could predict them together. I could predict them separately. It's really the same thing because basically all of them, they don't depend on each other, right? So they are independent inputs. So I'm going to choose predicting mean, but I could be predicting any number. I could predict volatility, I could predict correlation, and so forth. Okay, I have a question. Sorry, there is a question to answer. So GBP is the main variable, and the other currency are dummy ones. So let me just, first of all, this actually countries, right? Well, okay, so I see that there's a problem in the label because this is Great Britain, it's a country, right? All of the others are currency, so it's not even consistent, it should be GBP. Anyway, so the idea here is that we have a sample. And I think that I'll answer this question right now. It will be completely, it will be perhaps more clear than we actually look at the code because we'll be able to see what's in the data. But essentially, imagine that sample is a table. Each of these are columns, right? So if there are 16 currencies, there are 18 columns in this table. First column is short rate, second column is long rate, 10-year rate, and then there are a lot of 16 other columns in which there are ones and zeros. The sample, each element of the sample, right, so each observation is one row of this table. So for each row, there is only one currency, right? So in other words, if that observation corresponds to, let's say, Great Britain, right? So British pound, I will say, okay, so in Great Britain, there was a point in time where there was minus 50 or whatever, let's say 1% short rate, 3% long rate. In the currencies, what is this, minus 50 basis points? Actually, well, I shouldn't have put one here for Great Britain because I don't know if it actually happened, but I don't think it was that steep in this currency. So, but anyway, let's imagine that there was a data point or time point at which in the UK, there was a short rate was minus 50 basis points and the long rate was 3%. That's one row of this table. Next row will have British pound will have 0, but euro will have 1. That will be an observation for the euro. So essentially, it's a table in which there are columns. Each row has one in only one position, and that's the currency for which the observation happened. In the first two columns are the short and long rate from that observation. Have I answered the question? Okay, so second question, right? Will one hot encoding be too sparse? It is too sparse. That's actually, it is very sparse. That's the reason why conventional statistics doesn't work. It's sparse and also it's very nonlinear. In fact, it's a little bit of misnomer because it's so high dimensional that, in very high dimensional space, kind of this whole concept of linearity kind of goes away almost because, there's no, there are so many directions, like, concept of linear kind of almost stops being meaningful. So it is very sparse, but that's the only way to avoid bias, right? In other words, we don't know which currency is similar to which other currency. If we start ordering currencies, that would be subjective, right? So maybe we come up with some way to estimate. Yeah. So basically, I wanted to use as an example something that that would provide a very clear use case for the practice session, right? So you can definitely instead of using one hot encoding, encode in a different way. You can, for example, as I mentioned, use various economic parameters or some other things about the currency. You can potentially say, okay, I'm going to measure mean reversion target, right? So in other words, I'm going to separately measure some characteristic of the currency and then order them according to this characteristic. But you know what? If you use this data, the same data, to measure that, machine learning will do it better for you, right? So the power of machine learning is that it's actually very strong in detecting very subtle relations in data. So I am convinced, and if you don't believe me, you can, you're welcome to try it, with the same model, right? So you have the model that we will work with in a moment, right? And you can also build more traditional model. So if you don't use one hot encoding, you will impose some order on the currencies. And essentially, what will happen is that you will introduce a subjective information, right? So you will guess what the currency is, how currency is ordered. So that makes your model subjective. Sort of almost like saying, well, my model is log normal, right? Just because, that's the equation I like. So with machine learning, the whole power is that you don't have to do it, right? So in other words, one hot encoding is the way to completely say it's unsupervised, right? So I am not providing any input. Any other encoding, that's the only, you can prove this, one hot is the only encoding where all currencies are equidistant. You're not making any judgment about which currencies are similar. Anything else, you're making the judgment. So it's no longer unsupervised learning. It may work, but the power of this model is that it works and it's completely unbiased, right? So in other words, it does not have, risk managers actually like that, right? Because it doesn't have any such subjective input to it. So you can use other encodings, and there's question 3, will embedding encoding help? So we probably need to start moving forward because we still have plenty to work on with Python, even though given that only a few people wanted to do hands-on, that allowed us for more time. But I think at that point, I should probably defer further details on these answers until we get to the code, because I think it will be more clear. But the short summary is that any other encoding is improving the model essentially with applying some subjective structure to the data. And if there is not enough data, it may be a good thing. but the model we're building is completely unsupervised, and we're not assuming anything about currencies. All right, so that's the one rate in one hot encoding of currency, right? So on the left we have the short rate, the currency bits. In the right we have short rate. On the right we have short rate after 5 years. That's what we'll be doing. Tomorrow will be well, if we get to it, we'll be working with two-factor model, right? So we have short rate and a 10-year rate, currency bits, and we get short rate and a 10-year rate in the output. With the generative model, we'll be getting samples, right? With regression model, which is getting like mean of this, mean of that, but also we could also make things like correlations. All right, so now with that, practice session. So this is a plan. We may or may not be able to get through that, depending on how fast we're moving and how many questions. And also, if somebody wants to try it, this will probably takes a little bit of time to coordinate. So, but let me tell you what we would like to do, and maybe some of it we'll do tomorrow. Because the theory was actually, I covered most of it today, and tomorrow theory will be a lot shorter, because I will not be talking about fundamentals of the model, Bayesian, flying dinosaurs and so forth, but only about the generative models, which I didn't cover today. So tomorrow's theory session will be shorter and practice session longer. So it's okay if we don't finish this entire list today. But what we're trying to do is the following. We will first model synthetic with generated data for 1 and 2 economies. And what do you mean by 1 and 2 economies? So we'll have 10 currencies. And one economy means that each of these currencies will have the same calibration of the model. Namely, same mean reversion speed, same mean reversion target, same volatility, and so forth. So they're different currencies. They will have different interest rates at any given time, but they will be essentially having the same model calibration. That's what I mean by same economy. And 2 economies mean that there will be 2 sets of data, right? So two sets of parameters, rather. And again, remember, this is synthetic data. So we're going to use several models. We're going to use 3 models to generate it. First model is the Hull and White model. It's actually not a good model if you're doing real-world modeling in for 30-year horizon. Actually, it's not a great model, period, if you do going 30-year horizon, even reasonable measure. It will predict very negative interest rates that cannot happen. It will predict very high interest rates that cannot happen, that persist for a long time. And of course, the volatility is really very far from normal. It goes very low, when the low rates, it goes, much higher. High rates. In fact, the volatility that there was a pioneering work by De Guillaume, Pagudin, and Ribanata, who basically used kind of actually somewhat similar approach to what we're going to use, except it was way long before machine learning. But we have a conventional approach that's actually kind of rooted in their idea, right? So they've discovered that the volatility of interest rates is log normal for very low rates, shifted log normal for very high rates, and normal in the middle, which is why everybody's using Hull and White, because when the rates are average, that's what you want. So we will use the first model we use is Hull and White model. It's not a great model, but it makes very clear predictions we'll be able to verify easily. For example, certain graphs that we'll be drawing should be the straight line in Hull and White. So by looking whether we end up with a straight line or not, we'll be observing basically whether the model is performing or not. Then we use a more realistic model for the short rate, where it can, when it goes very negative, there's a very increased reversion, so it basically jumps back out to high rates, to positive rates. And also, if the rates gets very positive or very high, rather, inflation starts. So the central bank is always fighting it. They're doing various things with the economy, and usually they're successful in most currencies. And what it means is that it's like a Hull and White, but it has increased reversion speed for negative rates and for very high rates. So it kind of constrained to the normal interval better. And then there is a 2-factor model, which has the long rate, which has reversion to a fixed target, in the short rate, which reverses the long rate minus the risk premium. So that model is actually the original formulation of 2-factor Hull and White, because when you have G2 model, G2 model is like basically symmetric formulation of Hull and White. But when Hull and White formulated the 2-factor model, that's what the original idea was, that the 10-year bond or whatever, the long rate, is reverting to a fixed target, and then the short rate is reverting to a long rate, which only if you believe in things like SABRE or LMM, that's exactly what you expect to happen, right? So at least in reasonable measure. So we will have basically 3 models. One of them is very simple, so we can easily verify the predictions, and 2 of them more realistic, so we can make sure that our machine learning model works on some realistic data, that realistic-looking data, but still the data that we can, that we generated and we know everything about. And only when we're convinced that the model is performing properly, we'll unleash it on OECD, on real historical data set. So this first thing is extremely important because it will prove to us that the model we built works. And then second thing we'll do is that we'll model OECD data average across all currencies, right, and compare with conventional statistics. As I mentioned, you cannot build a model for the specific currency without machine learning. But if you just remove currency label and build a model for quote unquote like average currency, right? So once basically all of the observations from all currencies you put together, you can still, first of all, I mean, it's not completely, obviously it's useless to a risk manager. It's not completely useless. I would say it's useful to a quant because you know how people use the same mean reversion for all currencies of 5% per year, the same mean reversion speed. So, well, it turns out it's actually is indeed very similar to most currencies, except when the rates are high, it's higher. So this model that kind of averages across all currencies, even in conventional statistics, you can, things that you think are similar for all currencies, you can perhaps measure. But this will be just to make sure that our model on real data can be compared with conventional statistics, because conventional statistics cannot be used for single currency, but can be used if all of the currencies are combined together. And finally, we're going to apply this one hot encoded model to real OECD data. And we'll look at real currencies that have a lot of data and make sure this data is respected and the model does not deviate from observed data when there is a lot of it. We'll look at real currencies with less data and see how it's extended, right? So in other words, currencies in which there are only low rates, what it will predict for high rates and vice versa. Then we'll look at hypothetical currencies with no data, right? So currencies which don't exist. They have no data. For example, a currency was just introduced, right? See what it will predict. We hope it will predict some sort of a proxy, right, to average. And then hypothetical currency with small amount of data, and also we'll try to put some unrealistic data there, right? So one amazing thing about this model, which I really like, is that if you give it some nonsense data, so if you give it absurd data, like for example, short rate goes up, but the long rate goes down always, right? Expect basically the yield curve kind of move. You expect the parallel shift in the yield curve to be significant, right? So in other words, if the short rate like went up 5%, you don't expect the long rate to go down, at least not often, right? It may happen rarely, but actually, well, it does become inverted, right? But normally what happens is the short rate goes up and the long rate goes slower. Eventually, at some level, they equalize, right? What you don't expect is like this. So when you give it the data, which is like this, it just refuses to fit it. I mean, that's the amazing thing about this model. Basically, like it says, well, that cannot happen, so it must be some sort of a fluke, right? So I'm not going to use it. That's what we're going to check as well. So with that, let's try to get some code. Anybody has any questions just before we start the practice session? Okay, so let me see here. So I'm going to stop sharing the screen. So zoom here. Okay, so I'm going to stop sharing. And at that point, again, so two people I saw that wanted to look at the code. So here's what I'd like to propose. Anybody who would like assistance in running the code during the session, please observe what I'm doing, and when you're ready to start, you can basically follow it, or you can right away follow what I'm doing. And if you encounter any difficulties, please send direct message to anybody who is, you can see, co-host, namely Andrew, Anastasia, and another Anastasia. And we'll make sure that you get help. And if you'd like more hands-on help where you'd like to share the screen, in this case, please join the breakout room, and you'll get some help there. Okay, so let me see here. Right, okay, great. Right, so with that, let me go to PyCharm. Actually, just before we do that, let me just go to GitHub first of all. 1 second, and we can then get started. Okay, so let's see, the screen sharing. Okay, so first of all, just a couple of housekeeping things again. You know, basically for anyone who'd like to try it now or later, I just want to make sure we get it out of the way. So the repository is at this URL. We're going to distribute the URL. I'm going to actually type it in the chat right now, just so everybody has it. 1 second. Chat. Sorry, am I sharing the screen or not yet? Can you see my browser with the GitHub screen? Can anybody unmute and tell me?
You can see the Zoom screen.
You see the Zoom screen, right? Okay, 1 second. So I guess somehow I didn't share. Maybe because the screen was minimized. Let me just try again.
No, I guess that might be the GitHub. We can see the magic quadrant.
Which quadrant?
The Gartner Magic Quadrant for meeting solutions.
Sasha, you are sharing the main Zoom screen.
Okay, but I see. So I didn't realize I was unwittingly advertising Zoom's brilliant success in the Magic Quadrant, but that's not what I was going to share. Let me just share the entire desktop. Maybe so that's going to work better. Okay, so let's see. Okay, so I'm attempting again. So screen, right? Okay, so screen 2. I see. Okay, so actually, I realized what happened. I guess my screens are interchanged, right? Do you see the right?
Yes,
see the right
that's right now.
Okay,
Thanks.
good. Yeah, it looks like my monitor number 2 is actually on the left. Okay, so you're on GitHub. This is the URL. I posted it in the chat. We're going to distribute it as well. And this is CompatibL site, Practical Machine Learning Workshop Series. Okay, so you can clone this code in this Python code. And I'm going to show the URLs here. So again, so the URL is here. And basically, if you clone it right now, you should see something like this, right? So this develop branch you will not see because it's where we worked with the team. You should be able to see this commit, added possibility to switch from matplotlib to plotly. Okay, so now we're going to go to Python. And let's see, where's my Python screen? Here. Okay. So let me go through the code structure, and we're going to just quickly again. So let me just, even if you're not trying to do it right now, I assume if you went to this workshop that you probably wanted you know, to be hands-on with Python. So let me just do a couple of things here. So first of all, this repository has requirements txt, right? So there are various ways to set up your requirements, you know, basically the packages that it depends on. This is something very simple. It does not require setup py. So there's file called requirements. And if you open it, you see that there are this list of requirements, and you can go to the Python terminal, right? And after you created the virtual environment, you go pip install -r requirements txt. I'm not going to run it because I already did. This will install all the packages that you need. Okay, you may not have TensorFlow access to GPU. It requires various NVIDIA libraries. So just to make it more portable, we just suppress this warning so they're not annoying. Anything that will be running today is actually extremely fast. And in fact, we specifically tried to choose the model so you don't have to wait for an hour for it to train. That's why we chose 1-factor model and not 2-factor model. And also that's why we're using fewer layers. Normally we use 2 layers. And if you are listening to my presentation at the November conference or this conference, so I was describing network parameters. There are 2 layers in the model that's in the paper, so swaps. But here we're using 1 layer because first of all, OECD has less data. And second, we did not want it to run for a long time. So now the code is organized the following. Again, please confirm that, can anyone confirm that you see PyCharm right now?
Yes, we do.
Okay, and you know what? Actually, let me just switch to another repo because I think of. Okay, so that's the internal repo. So let me just open a new window. Okay, so that's the right repo. Yeah, I have just 2 copies. One on our internal Git server and the other one on GitHub. So I'm switched to the one on GitHub. We should make sure that we have exactly the same version. Okay, so let's just get started, right? So just quickly review. First of all, we have folders with is with Python, right? So test train folder tests, and that's what unit tests are. We're using PyTest. You need this PyTest INI, and you need to set up. If anybody is using PyCharm, just make sure that if you type PyTest here, is selected right here. If it's not selected, your test will not run. And I'm going to go and just make sure that all the tests run. So please do the same if you install and try to repeat it, because otherwise you may be fighting basically something that you don't understand, it maybe just because some libraries don't exist. So all of the tests passed, that's good, right? Okay, so now this actually test that just make sure that the code works correctly. The real results are in runs folder, right? And we have the following here. First of all, we have OECD folder. Let's start from the data. So in this OECD folder, I apologize if I'm looking to the side. I'll just see if I can rotate maybe my camera a little bit so it doesn't look weird. The OECD folder is where you have OECD dataset. The data that we're looking at is this short rate CSV file. It looks like this, right? So that's the currency. STINT is short-term interest rate. That's the name of the ticker or indicator. They call it indicator, but it's really the ticker for the short rate in OECD. I have no idea what these things are. QU is quarterly, but we're looking at monthly data, which is further down. We're going to filter monthly data. And this is 1974 quarter one, but if you go a little bit further, you'll see monthly data, like for example, 2009-12 means December 2009, and this is the rate in percent. In PRT is probably Portugal, right? Same thing for the term rate. So I call it the term rate just to distinguish from the forward rate, but that's the long-term interest rate indicator, which is basically the 10-year government bond yield. I also downloaded the FX rate, but we're not going to use it right now. Okay, so now there's this code here that analyzes it, and the code also produces various data. So I'm going to run this code, so 1 second. Yeah, I'm going to run this code because what this code does is it produces all of the charts. And if you add the data, you'll be able to rerun the code and see the charts. So let me just run 1 second. So it will simply load it and then look at various or produce various samples for the data that I'm going to use. Okay, now this thing keeps let me see here. So I guess I need to 1 moment. I'm going to close all of these windows so I can open them again. 1 second. So, okay. So let me run again, and this time hopefully it will open the browser in the right screen. Otherwise, I'll move it. 1 second. So basically, this thing we're using a library called Plotly, which produces interactive charts which opens in the browser. Which I think once again it opened in a different window, but you can see here. You see, basically, you see it's opening this window, it's generating them. So I'm going to keep it on here. So it just opened all of these charts. It also saved them on disk at the same time. So these charts are interactive, right? And if you're working with the data, what happens here is that you have the points. So you can click on any of this and make it disappear, right? So if you click here, all the points will disappear. So, and also you can do things like, for example, zoom interactively like this. So it's a very good library for that. So let's just take a look at the data and see exactly what it is. And we can also, basically look at the saved versions here, right? But looking in the browser is better because we can zoom and look interactively. Okay, so this is leg sample, right, for the short rate, right? So that's what we're interested in. So we got the values, right, which are blue points. Yellow is the mean, and green is the volatility. First of all, you don't see the currency labels here, and that's because this example merged the data for all currencies, right? So in other words, we ignore the currency dimension here. We just want to see the shape of the data. And this is the chart that for machine learning model for understanding it, it's extremely useful. Alexei Kondratev, I think should be credited with popularizing it. And I hope you'll get used to it because, initially it was for me kind of a little counterintuitive, but now I finally understand how it works. So in order to use this chart, I'm going to I have a few slides on how to use the chart, right? So this is an example of similar data. It's actually the same data, right? So the only difference here is that we're looking at red, which is this machine learning fit. We're looking at this green, which is essentially the way that this green and black lines are produced is the following. What you do is that you take a bucket, for example, from 5 to 6%, then you average the points in the bucket, and that's the point on this line. So in other words, imagine that this piece is a loaf of bread, right? You slice the loaf of bread vertically, like this. So you make a slice which is basically 1% wide or 2% wide. Then you average the points within, so you got basically like a histogram across, right? So basically there are no points here, there are more points here, there are less points here. You can take the mean of these points or the median, right? So green, I think so green is the mean and black is the median. And also yellow is the volatility, right? So it's one standard deviation around the mean and the median. So as you can see here, machine learning is actually, when there is a lot of data, is pretty close to to very primitive statistical method in which are just using bins basically. Just like like in historical VAR, like using bins basically for quantiles. So here I'm using also bins, but except for the average, right? And as we see here, the mean has a slope and then it flattens, right? Here, where machine learning is better, because machine learning, is more stable, and because it becomes more rigid as there's fewer points. So with these bins, because there are fewer points, you get more fluctuation, right? So we don't think that the mean goes down here, goes up here. It's not real. It's just because you only have a few points. But notice also that there is this yellow area is kind of getting wider and wider. So there is a way to interpret it. Which is, first of all, what we're trying to accomplish here, right? So first of all, if the short rate is high, then there is mean reversion, and there are kind of tails up and down, right? If the short rate is low, there is mean reversion up, but also it cannot become even more negative, right? So if you look at the chart, so what happens here, this is the initial short rate, and this short rate actually after 2 years, the data that we have live is after 5 years. So if the rate is here anyway, right? Well, it cannot be very negative. So if you're starting here, you have a very wide probability distribution tail up, but very narrowed down, right? So that's what you get. So that's what you see in the data. That's what your machine learning model should also predict. Tomorrow, when we'll be doing generative models, we will see that that's exactly what they do. They don't generate the data that never happened in the past. So we see this huge asymmetry here, right? Okay, now second thing is that on this chart, no mean reversion means mean, right? Which I'm talking about this red line, right? Red line or dashed line. So if this red line, which is the mean of the distribution of the points in the chart, was straight and x equal y, it means no mean reversion. If there's a constant mean reversion speed, it's the slope is less than 1. The longer the time, the less the slope is. So if time is infinite, it will just not determine the initial state, right? So what does it mean when it's horizontal? It means that the initial state was so far in the past, you just like, the rates today don't depend on what they were 100 years ago, because, basically the dependence on the past rate has long, been forgotten. So the further it is in the past, the more flat it is, and mean reversion is the mechanism by which it happens, right? So this is depends on the time and the rate of mean reversion. And this intercept where with the x equal y line is the mean reversion target. So that's the rate. Think of it this way, right? So if you started here, right? If you started here, if the rates are high, they will come down. If the rates are low, they will come up. If the rates are exactly the mean reversion target, they will remain the same. That's what makes it mean reversion target. Now, what is this thing? Well, if it has a slope and then it's a flatter, it means increased mean reversion speed. What it means is that higher rate, right? It kind of goes to, because eventually it will go to flat because it will forget where it was. So faster mean reversion means that in a given period of time, for high rates, it kind of forgets faster. So when it flattens, it means that for high rates, it reverts faster. High rates persist for shorter period of time than you would expect them, looking at the 5% per year mean reversion rate. 5% per year is not, imagine like what's 5% per year, right? Imagine the interest rate, let's say, is 20%, right? So 5% per year mean reversion means that 1 year later, the rate will be 19%, then 18%, then 17%. That's not what happened. It's completely obvious that the 5% mean reversion rate is absurd for rates that high. Central banks will be fighting it tooth and nail, right? The government, will be doing something. They will be printing money. They will be borrowing, whatever, trying to jumpstart the economy. So whatever this mean reversion rate is not 5% per year at rates that high, right? So if the rate today is 20%, 2 years from now you expect it to be like at 15, right? Or maybe runaway inflation will happen, but definitely not just stay there. So that's what it is, and that's what, by the way, models like Hull and White don't predict, but the machine learning model does. Okay, and then imagine there is normal volatility. That would mean that the standard deviation around this chart would be constant. If the volatility was log normal, it would be like straight lines, right? So this yellow envelope that you observe here, right? So this envelope is at each rate level is one standard deviation. So this is normal. This is log normal. This is what's the Guillaume-Pogudin-Remonata that I mentioned, right? So log normal, normal, and then shifted log normal, right? So that's actually how, as you notice, that's exactly how it looks, right? It widens, then it's about constant width, then it starts winding again, right? So that's why Guillaume-Pogudin-Remonata's conclusion is correct, right? To do this valid in this data set, even though they made this conclusion completely different set of data. And here's just some measurements, right? So mean reversion speed increases the rate of mean reversion per year, right? It increases significantly multiple times, right? From 5% to about 30 or 35% for high rates. And volatility is exactly what the Guillaume-Pogudin-Remonata predicted. Log normal, normal, shifted log normal. Okay, so let's take a look here, right? So what we got is exactly what the Guillaume-Pogudin-Remonata predicted, right? So, sorry, one second, there's my browser is somewhere here. So let me just blow this up a little bit, right? So yellow line is, maybe I should use dark background. Yellow line is linear, then it flattens. That's because at this rate level, mean reversion is faster in any currency. Volatility is log normal first, then normal, and it doesn't actually increase here much, right? Just because there is not enough data. But basically, it's just a function of this particular set of points for 5 years, right? So for 2 years, you actually see that that is increasing. It's just this tail end here where it goes is kind of a statistical fluke, just because there are a few points there. But it's absolutely unmistakable that it flattens. So that's very clear with traditional statistics, and of course economists know about it, and that's what the machine learning model will show. Yeah, Andrew, how do I switch to dark mode? I think it's going to be easier to see.
There is a variable in util, plot util.
Plot util, right? Yeah, okay, let's see here. Any questions so far? Anybody? Again, if you have a question, I don't want to be constantly looking at the chat, so please let Anastasia know and she will tell me.
Here, light 18. Line
okay, so dark mode, true, red. Oops, true. Okay, let's give it a try. Yes, it looks a little bit better. Right. Okay. So so that's the next chart, right? Okay. Well, now the legend, you don't see. The legend's too dark. Never mind. Right. So we should have.
You can change the legend color. Here is where is 000.
Where is it?
Here. Yeah. So
this
please set
what should I change it
to? 6F. All
right. Yeah.
All Fs.
All right. 1, 2, 1, 2, 3, 4, 5, 6. Okay. All right. Well, if it doesn't work, we're just going to revert back and give up on it. But I think it'll be easier to see. I hope. Okay, so yes, I think we're in business, right? Okay, excellent, right? Okay, so now here's how it looks by country, right? So because previously, previous data was all like mixed up for all of the countries, right? So now this data looks separate. So yellow is mean for each currency, green is volatility for each currency as a function of rate level, right? So let's contrast it with this, right? So this actually is what is a long-term rate, right? So just so So it's the short rate, right? So we're going to contrast these two things, right? So we're going to contrast this, and let me just maybe make it just a little bit smaller, so larger rather, sorry. Okay, so this is the data for all currencies. You see yellow line is smooth. Yellow line, again, is that you slice this like a loaf of bread, and for example, between 10% and 12%, you just average, and that's the yellow is the mean, sigma is a standard deviation. Okay, so now the same thing here, right, is you get very, very noisy data, right? So it goes like here, then it goes here, right? So in fact, if you just, click, let's see, double click, like for example, is isolate. So it's USA, right? That's Denmark, right? Okay, so then, well, this volatility, right? So well, it assumes that zero volatility is huge volatility, right? So this is like 4% normal volatility, right? And zero. And this is, this again, so it's Denmark, right? So if the short rate is below 2%, it thinks that it will basically go to zero. Okay, so then between 2 and 6, it thinks it will be 2%. Then 8%, it thinks it will be 10, and then it comes down. Okay, so that's a clear example when you can see its randomness, right? Because basically, normally, the higher the short rate today, the higher the short rate is in the future. It's not going to go the other way. So now another thing is that if the current rate is 18%, it just absolutely convinced it's going to go to 4. Right? In other words, this data makes no sense, right? So in other words, there's not enough data here for a single currency model. What happens here, if you look at the specific points, there's just so few points, you basically don't get the real data, right? So again, so if you basically get back to all of the data, right? So you get complete noise here, and what we would like is to put a straight line for it. Now this line, right, from the other plot, sorry, I'm looking around the camera, right? So this yellow line, right, from this plot, which mixes all of the currencies, is right in the middle, like it's in the middle of this, right? Because essentially it's the average of all of the currencies. The thing is, it's different, right? So you know that some currencies, they go lower, some currencies go higher. So the yellow line is, each of this yellow line is what we would like to compute. We'd like to compute the drift in real world measure of the interest rates for each currency without mixing all currencies together and dealing with the quote unquote average currency, right? And as you can see here, it's not easy for the conventional statistics, and it's also not easy, sometimes your statistics fails you, but you can just eyeball it and your machine learning in here, right? Or rather, natural learning, your neural network fits it and you can see where the data is, right? But it's not this case, right? It's hard to see exactly which currencies here have, because some currencies, like given the initial starting rate, some currencies will have higher, given the starting rate, let's say of 10%. Some currencies will have trend up, some currencies will have trend down. There are some currencies for which the rate like at 10% is normal, right? Developing world. So in this case, the drift will be more or less zero, right? So they'll be stay the same. But some currencies, 10% is very high, like the United States, right? So the drift will be down. You cannot really distinguish this here easily. And that's what we're trying to solve now. Okay, any questions about this chart or the data? Okay, so if there's no question about the data, let's see if we can produce this data, right? So can we make this data ourselves? Why do we want to make this data ourselves? We want to make this data ourselves because before we unleash this model and say, hey, I have this model, it makes this wonderful prediction, please believe me, right? So, well, I say, well, how can you prove it? Well, unfortunately, we don't have 50 alien worlds in which we can experiment with real interest rates, right? So we're going to generate synthetic data and then use this data. So basically, we're going to experiment with our model on the synthetic data. So we'll first try to generate data that's realistic, and we're going to use the model. So let me go to first of all, Hollow White, right? So I'm going to Hollow White. I'm going to run it first. Let's run it. So basically, the way this data sets is 1, 2, 3 go in a sequence of kind of more currencies, longer data, right? More data runs longer. I'm just going to start from 1, right? Okay, so here's Hollow White generated data. It doesn't have a lot of data here. So it kind of looks like historical data, just because here I also generated only very short time series, right? There is currency 1, currency 2, currency 3, and currency 4. 4 currencies, right? So 4 means and 4 green lines. So if I look at this, I will say, well, these are different, right? But no, it's just because there's not enough data. In fact, it's one economy means it's all the same settings. And we can see that if we're going to run the second model. Okay, so that looks a little bit better, but still, there's some random, deviations here, right? So you can see that they're closer, right? And if we run the third model, which is even more data, which hope it doesn't run too long. Normally, all this run like a minute or two. By the way, I can just keep doing something else in the meantime. Okay, so now this is a 2 economy, right? So I can run multiple processes, right? So while this is running, I'm going to go and run 2 economy, right? So what 2 economy does, if you look at the code, right? So let's inspect the code. We have hollow white model, and I'll go in a little bit more detail what it does, but basically it's very simple hollow white model. It's even, in reality, it's even Vasicek model, right? It's not even hollow white. So it has 30 years, right? We use countries, right? So you see what it does here is that for the 2 economy, so for the 2 economy, it uses different reversion target, right? So for even currencies, it uses 5% reversion target. For odd currencies, it's using 15% reversion target. Otherwise, it's the same, right? So I'm going to run it, and this will show me the result that basically will be this kind of not enough data, I guess. Let me see here. Okay. Sorry, just a lot of points here, so it's drawing for a while. I hope the browser doesn't crash. Oh. Okay, so right, so this is actually the single economy, right? So what you see here, right, is that this is the hollow white model with 1 economy, right? It has completely constant volatility of exactly 1%. Let me just go back to the previous, right? So now what you see here is, again, for each, so basically the way that I ran this longer, right, and the way that I got such a perfect plot is by having many currencies. So each currency has a natural statistical variation because I didn't run one currency for 1,000 years. I ran 1,000 currencies for 30 years. So there is still over 30-year period, the variation in the data here, but you can see the straight line. You can see that this is a constant, right? And if you average across currencies, you get a lot better, right? So this is a straight line. So now another thing is that the reversion target for 1 economy is 5%, right? So if the rate is 5%, you can see that the intercept is exactly, this is good about plotly, this, you can actually see, hopefully. You see, well, you know what, I think if I click this away, then I will be able to see it, right? You see, it goes straight for 5% point here. It's because mean reversion target is 5%, right? So hollow white is normal, so it's symmetric around the target, right? So it's 5% here, 5% there. And the volatility here is exactly 1%. So we perfectly measured our, so basically this is conventional statistics. There's not yet machine learning, but our method helped us to measure perfectly the parameters of this hollow white model. So now with that, it's 2 hours. Let me just quickly ask for show of hands. So we can continue from, basically, if anybody is interested, in seeing the first machine learning model, we can run maybe another 10 minutes and I show it. And this will get us like to a more natural starting point next time. But if people have to go somewhere in the meeting, then we can, given that the theoretical part will be a lot shorter in next tomorrow, then we can stop at this point. So let me just quickly ask through the chat. Basically, anyone needs to go somewhere like right this moment, or can we go another 15 minutes? And by the way, any other questions also welcome. Okay, so I don't see any protests. So basically, let's just continue a little bit because you know, we'll run something with machine learning, right? But I don't want to just go and run it without putting it in the proper context. Okay, so as you see here, you know, we basically got this data that is exactly what we expect, right? And if we're going to go and, you know, do to economy data, let me just close the browser just so it's not slowing down the computer, right? Because basically what happens here is that when there are, you know, millions of points, hundreds of thousands, and each one of them is a JavaScript object, so the browser gets kind of slow. But it's still, you can still look at the PNG file, and we can turn off the Plotly browser if it gets annoying, right? So in a two economy, right? Let's go and run, let's say, two, right? So it's going to be 10 currencies, but for longer time, 300 years. Okay, and what this does here is, again, so we have half the currencies. We have half the currencies, as you see in the code here, right? We have half the currencies with 5% reversion target, half the currencies with 15% reversion target. And the countries' names are generated 001, but basically even currencies are 5% reversion target. So they basically mean revert to 5%. The rate mean it's not the speed, right? It's the target. So mean revert, so interest rate mean reverse to 5%. Here mean revert, interest rate mean reverse to 15%, right? Okay, now let's take a look here. So first of all, this is all of the currencies, right? So all of the data thrown together. And as you see, well, there's basically various areas here. So if you actually, like here, you can see, say, well, this just looks like a little uneven data. But in reality, what happens here is that you see this is centered. So there's like less points density here, but there's a more point density here. So this looks like an ellipse. This looks like an ellipse, right? What happens here is that this is centered around 5%, and this is centered around 15%. So so currencies start from random points. Depending on which currencies you are, either you gravitate here or you gravitate here. That's what makes this look like that. And this line here, right, is actually this line here is actually a combination of two lines, right? So what happens is that if you look at this data, these are by currency, right? So, for example, this is intercept of these yellow lines, right? So this yellow lines is the mean of where rate will be after 5 years is a function of the rate today. For these currencies, if it's at 5%, it will stay there because that's the mean reversion target. If you start at mean reversion target, you will stay there. If you start above the target at 10%, it will start mean reverting, so it goes toward 5, right, a little bit. If you start at 0, it goes above toward 5. But however, if you're in this currency, right, then you see that's a very interesting point, right? Suppose that you started at 10%. If you're this currency, right? So, and these are all even currencies, right? I don't need, you know, you can look at the label, right? But these are all even currencies, right? It's 4, 2, this is all odd currencies, right? 9, you know, 3, right? If you're an even currency, you may revert down. From 10%, if you're even currency, you may revert down, otherwise you may revert up. And you can see it, this is even, right? So that is a straight line. Well, if you get more data, it will be, right? And this is also a straight line, but a different position. You see, so even currencies, odd currencies, both currencies. Our objective is to see if we can use machine learning to detect which currency is which and fit properly the currencies. So once we do that, we'll finish for today. Any questions just before we get to this point? Everybody, I just want to make sure that nobody has any questions about and if you do, please ask about what we're trying to accomplish, right? So we're trying to use unsupervised learning to determine which currencies are cats and which currencies are dogs, right? So some currencies are here, some currencies are here, right? Some currencies are these currencies and some currencies are that currencies. We don't know which ones. So our machine learning model will take the data and sort them into the user sorting from Harry Potter, right? With this, we'll use the sorting hat, looking at the data that we do have, and then after it uses sorting hat and put it in the right group, it will then it will then use the data from all the other currencies in the same group to extend the data. So basically, we'll say, well, this currency is like these other currencies, and I'm going to use the data for these other currencies in the area of risk factor space where I don't have the data for that currency until I get the data there. Once I get the data there, I'll use that. Any questions about what we're trying to accomplish? Okay, so hopefully that is a good thing. And let me just quickly close all these extra windows. And let me see, go back to PyCharm. So Andrew, please remind me, which one is a two currency DNN, right? Run.
Yes.
Okay, so one economy model. So should we run like one economy model first?
I would say no. Just
okay, just the interest of time. Let's do two economy model.
Yeah.
Yeah. Okay. So let's do by. So okay. So now there are two ways to run the data, right? Actually, there are four ways, right? So first way is that if you don't use the currency, you can use raw data, right? So if you look at the browser, you can feed to the model the blue points. If you feed to the model the blue points, you will basically asking the model to find out where the mean is of this cloud. And the way it's done is that you give it half the points where it will learn from, and then we'll use the other half to see to train. So you use the half. It's the same approach as used in smoothing spline and most other algorithms that basically try to do regression. Use half the points to train and then see how accurate you predicted the other half. You're not trying to predict every point. You're just trying to minimize the least squares on the remaining points. And again, so this is not train and test. Both of these are train, right? So I'm just to train, I take half the point, put the line through, and then see how accurate it represented the other half. And I'm trying to improve my neural network parameters until it's optimized. So what you can do is that you can use the raw points, or you can use the points in buckets. Now remember the frequentist versus the Bayesian, right? So sometimes the interest rate just happened to spend a lot of time in a particular area of space, right? So for example, it just got stuck like 5%, right? The fact that it got stuck there for longer than let's say 10% doesn't tell us anything where it will go. Like once it's there, right? And was like suppose that my rate today is 5% versus 10%. My probability of going from there, if I really believe that the model is Markovian, and there's a lot of evidence as Markovian. In fact, there are a lot of people in hedge funds, working very hard for us, so to make a life of mathematicians easier by making things Markovian. Because if not Markovian, you can then make money that generate alpha. So they generate alpha, move to market until it becomes Markovian. So thank you to all of the people who work for the hedge funds for being so nice that helping basically make it easier for us to model, right? So we expect it's Markovian. So it means that our probability does not depend on whether the rate was stuck at this level for 10 years or for a year, or like just for a few days. So there's an argument that goes, right, that what you should do is that you should use the buckets, right? So in each bucket, you keep this equal number of points. Right, so that's the bucket, right? So that's the bucket approach, right? Also, it has the advantage that it actually reduces the number of points, so it trains faster. So by bucket means that we took the blue points, then we averaged them in the bucket, and we kept the same number of points, in the bucket, right? So you can pass the bucket average, or you can just pass a subset of points in the bucket, which is equal. So if there is some area of space which is not well represented, you keep all of the data there. But if there is some area of space which is overrepresented, the race spend a lot of time there, then you get basically faster training and also more kind of equitable representation, which hopefully will create the accuracy, right? And then you can do one hot in the country with the bucket with the rate. So Andrew, I forgot which one. Sorry, so I think it's
by rate it will be too slow. I would say by bucket and country.
By bucket and country, okay, fine. Bucket and country. Okay. Okay, just one thing, right? And then while it's running, right? So one good thing is that while it's running, right? So first of all, this one already finished, right? This one is running. While it's running, we can actually look at something else, right? So let me see here. Let's do, okay, so first of all, it's already computed, right? And wait a second, so data all and data currency one. Right, okay. So so let's take a look here, right? First of all, remember, this is, so wait a second, I was running one country or two country, 1 second. Let's take a look here. So this is two economy model, right?
Yeah, two economy. So there are two buckets.
Model. Exactly right. So I got two buckets, right? Okay, so first of all, this is all buckets, right? And I should not probably close the other chart, but let's just quickly regenerate the we'll take, maybe we'll just open the chart of the two economy because we ran it already, right? So we should have two economy, one economy, two economy, right? So for two economy, let's look at even and odd, right? Okay, even and odd. Okay, so let's take a look at the browser now. First of all, which currency it is? It's currency one, right? So 1 second, is this even or odd? Okay, let's just change it a second, but I forgot. Is it even, or is it even if you subtract the one?
It should be
so
odd.
Yeah, okay, so how wide to economy, let's see, where's it? Wait, it's actually different pie chart. Okay, so that's the right pie chart. Right, so to economy country bucket plot odd, to economy, okay, it's fine.
Yes, country index +1.
Yeah, I'm looking for it. Yeah. Do you have it closed? One second. Did I run to another window?
Sorry, what are you looking for?
I think I probably ran to another window actually. 1 second. So to economy by bucket and country, right?
Yeah.
I think I may have run in the other window, which is probably fine. But let me just run to that window, just be sure. No, it's fine. It's the same. Yeah. Okay, good. Right. So so this one is currency one, and I'm going to run currency two now. Okay, so 1, 2, right? Okay, so now let's do 3. By the way, these are the parameters of the neural network. I'll go through it in the next presentation, right? Okay, so let's look at it. 1, 2, 3. 1, 3. 1, 3. All right, so well, in the interest of time, given that we're already 20 minutes late, I will not be writing all 10 of them, but we did before. So again, there are two economies, one for even currencies, one for odd currencies. First, second, third, right? And you see that these blue points is all of the data. And here you see points for this data, right? So, okay, so these are the points for this currency, right? Now, this is the point for the other currency. So let's take a look here. And again, I hope you see the blue points here, right? This particular currency only has the data here, right? It put this line through. In other words, how does it know that this is where the line goes? If this was data just for this currency, it wouldn't, right? The data points are only here. So we've established two things here. First of all, that one hot encoding is not just, one hot encoding, if you're not careful, one of the two things may happen. One is that you become, your model becomes a model for the average currency where it produces the same thing. That didn't happen here because look, 1, 2, 3, right? And 1 and 3 are nearly the same. And if I do 4, it will be over there with the second one. Now, second thing is that this currency has data everywhere, right? So you can see the blue points are, I promise tomorrow we'll find a better thing that looks better on Zoom. But you see that this line has actually data points, right? So that kind of align with it, right? And these data points are for the other currencies, right? This data points for that currency. And this currency just has 3 points here. It's just because basically it depends on where it started, it depends how long it's simulated, it's all random. So it's still new to prove the line here. Why? Well, it's because it knew that because because there are some other currencies that had the data, and that's exactly where it's supposed to be, right? So if you basically compare this to where it's supposed to be to this previous charts, that for the Hollow-White model, you can see that we achieved two things. First of all, we prevented our model from becoming the model for the average currency. We prevented our model from becoming a model just for one currency and ignoring all others. And we prevented them basically, and what it means is that when the data is there, it follows this data. But also the model by itself uses a sorting hat to figure out which currency is which, and then combine data from all of the similar currencies to produce a better model. So that's the first success of machine learning. And with that, I'd like to finish today's session. And tomorrow we'll run all of the remaining tests on regression model. Look at the architecture, even though, as I said, this is small data, shallow learning, right? So it's a very simple neural network. There's really not much to look at. In fact, all of the hard work is done by TensorFlow developers. So I will go through the architecture of the neural network. It's really incredibly simple. And really the key thing is how do you prepare the data and how to use the model, not how you optimize it, what architecture it has. So with that, I would like to ask any questions, and then we'll wrap until tomorrow 9 a.m. US time. Any questions? All right, well, there's still tomorrow for any questions. I shared the link. If anybody would like to try to run it, today will be a good time because then tomorrow I'll have the opportunity, or my colleagues will have the opportunity to help if there are any problems. All right, so Ed, I'll revert to you. Any announcements from the conference? Or otherwise, we'll continue tomorrow.
No, only thing to say is that we do have our forums at education.wbstraining.com. So if people want to go on there and post anything that they're having trouble with or anything, that might be a really good, useful place to put that kind of thing. But otherwise, That's it.
Great. All right. Thank you, everyone, and thank you for your time. And we'll see everyone tomorrow.
Thank you.
Okay,
See you tomorrow.